Hi, welcome to the session, IPOs for SMEs, Can Capital Markets Close the Financing Gap? This is going to be one of the absolute best panels at the Global Conference because we have incredible talent, and nobody on this panel has been working on this issue for less than a decade. And they come from all kinds of different perspectives. Two folks run exchanges. Two folks have done research and advisory for most all of their professional life on this topic. So I'm very excited to have you all with me. And just going down the line, we have Anna Carvajal, who's the lead financial specialist on capital markets development, financial markets development at the World Bank. Then we have Ashish Chauhan, who is the CEO of the Bombay Stock Exchange, really came from nothing and is a very important exchange in India right now. Nick Thadaney, who's president and CEO of TMX Group and one of the kind of world-recognized most successful SME exchanges out there. And then, of course, Siobhan Cleary, who is head of research and policy for the World Federation of Exchanges. And what I want to do on this panel is really unpack some of the issues of giving SME sector access to credit. As you know, in middle-income countries, access to credit is the number one deterrent to SME growth. And SMEs are, of course, the engines of job creation in every economy, not just in developing countries, but also in advanced economies. In developing countries, the number one impediment to SME growth is actually electricity. But the number two impediment to growth is access to credit. So getting money in the hands of entrepreneurs that can make productive use of these resources is fundamental to the engine of prosperous growth in a country. And of course, the other side of that equation, though, is the investor side, right? Making sure that investors have better outlets for their savings other than just putting their money in bank accounts where they earn, negative or zero or negative real rates of interest, to give that kind of banking sector some competition for household savings. So, Nick, let me start with you. How do you think about the challenge for SMEs to become part of public markets, access finance, and how have you at TMX kind of approached the strategy, and where have you come from? What accounts for your success? What have been some of the issues along the way, and how do you see the state of affairs?
That's a long question.
It is a long question. You have
okay.
1
minute.
Yeah,
I have 1 minute. Okay.
No, take the time you need.
Okay, so just for context, TMX has two exchanges. We have the junior exchange called the TSX Venture. Okay, and remember the word venture. It's appropriate. TSX. Then you got the TSX, the big board. Toronto Stock Exchange. So in that, these exchanges are over 100 years old, both of them, okay? One of them's 166 years old, one of them's 112. The junior market is effectively where we grow our little companies, and they grow into big ones. Here are some statistics. So between 2000 and 2015, there's been about 800 companies that have graduated up from being market cap companies so on the junior board, we've got roughly 1,700 securities, 1,700 companies, and the average market cap is $20 million Canadian, okay? So that's less than US. Now, if you think about that, these are small businesses. That was market cap I gave you, not revenues, okay? These are small businesses that aspire to be big ones. Some of them make it, some of them don't. Well, 800 made it in the last 15 years, and they graduated up to the senior market, of which 50 of them make up 55 of them make up one of our broad market index, which is called the TSX Composite. Is about 250 stocks, so it's more than about 20 to 25% there. And then 3 of them are in our big index called the TSX 60, all right, which would be the equivalent of like the Dow, all right. So these are little companies that grow up to become big ones, and access to capital is obviously a very important part of that. But in terms of just thinking about the reasons why people invest in those securities, well, you see that growth, right? Like as an example, last year we call our top 50 venture stocks. We for the calendar year, we identify the top 50 stocks. We call it the Venture 50. So last year, the average of the top 50 in terms of growth was 260%. So as an investor, you're like, that's pretty good, right? Now, not all of them make it, okay? It is a venture market. Access to capital is obviously one of the big themes that comes out. These companies come in. They have certain fears, which I'm sure we're going to get into. But I think what we're finding right now in terms of venture marketplaces is the perception of being a public company is not what it was, call it 20 years ago. And the reason for that is if you think back to our friends at Enron and WorldCom, they kind of spoiled the party for a lot of folks. And the ensuing years, you saw a lot of regulation. It made the story very, very, very difficult. So one of the things that we're spending a lot of our time is re-educating that constituent base and helping them understand how do you leverage a public market platform. And I think telling some of these stories and getting out and explaining how you leverage the platform is key to helping them get to accelerate their growth.
Well, I think you've just told the best story, right? That you start out on the venture exchange. You can, by doing things right, you work your way up to the big board, and then three of you can be in the top index, and having those companies tell those stories is going to be, I think, a key part of helping educate on the value proposition. And Siobhan, I'm wondering, have you seen that nice story, that nice trajectory across the world in the countries that you've worked on, or how are you seeing that, and what are some of the issues you've noticed?
Thanks, Staci. So just to give a little bit of informational background, we represent 64. We have 64 members within the federation. Across stock exchanges around the world, there are now over 40 exchanges that have a dedicated SME market. And by dedicated SME market, I mean a market with tiered or differentiated requirements for companies. So a lower entry point, as it were, and often with lower ongoing requirements as well. Over the last 12 years or so, we have seen growth in the number of companies listed on those markets from just over 4,000 to nearly 9,000 companies listed on those markets, so nearly 100% growth, as compared to about 13% growth over main boards of listed markets. So still small, certainly not plugging the financing gap, but definitely a viable source of finance for smaller cap companies. Part of the challenge we've seen, we recently conducted some research with Milken, in fact, across a number of markets. And part of the challenge we see, however, is that for smaller cap companies, and these are the ones who actually make it to market, some of the challenges of meeting the listings requirements either initially or on an ongoing basis remain. It is not easy, in part because it just takes time and effort to meet the requirements. One can talk about the quality of the disclosure that happens, etc. But meeting the requirements in a meaningful way is challenging for companies. It certainly disincentivizes unlisted companies from coming to market. And this is despite the fact that the majority of companies we surveyed actually did raise capital on listing, found that they raised capital at lower costs than they were able to raise from other sources, raised capital when they weren't perhaps able to access capital in other places. So markets are an option for smaller companies. The challenge is figuring out the balance between kind of getting the right kind of companies to market, making sure they comply, but in a way that is cost effective and affordable for those companies so that they can actually use those markets.
Anna, are these companies just kind of whining? Look, if you want to play in the deep end of the pool, then you have to kind of improve your disclosure and is the cost benefit analysis, is it worth it? Or how do you help the exchanges in the countries that you work with kind of make sure that it's worth the effort?
Thank you, Staci. Just to put my comments into context, in the World Bank, we have a program in assisting countries in developing their capital markets. And our programs span countries at different levels of development, from large emerging markets like Brazil or Russia to small developing countries like my own country, Costa Rica. And our program combines both policy and transactions that try to inform that policy and have a catalytic effect on the market. And through those programs, we are being able to draw some lessons. And the first one is that the public markets are suited only for a small segment of SMEs. And that is because of many of the reasons that Siobhan explained, and that can boil down to the informality of the small and medium enterprises in many of our countries that make it difficult for them to comply with the information requirements, but also to have a corporate governance structure that can provide confidence to investors. It is not that it's not worth pursuing, but it's that this is a long road for many of them and might serve just a small segment of them. But we are seeing actually that capital markets can help sustainable financing for SMEs in many other ways. And therefore, the key lesson that we are drawing is to look at the whole ecosystem of financing and trying to find other ways to get that financing to SMEs. And many of these options are in the credit space, and what they try to do is to leverage traditional funding sources like banking funding, like trade financing with capital markets instruments, and therefore have a much more multiplying effect. And in this way, they can reach a wider number of SMEs than what the SME public markets can do. So we like to, in our programs, assist countries in developing all these different mechanisms.
Okay, I'll let you talk more about that, but I do want to pursue this particular question. Is the regulatory burden too, well, Ashish, why don't I ask you then? Is the regulatory burden just too onerous on the National Stock Exchange, or how do you make that balance for your stock exchange? Is that kind of the niche that you moved into? Did you just water down the requirements enough to get everybody on your exchange, or how do you make it so that you're protecting investors, but at the same time trying to make it worthwhile for SMEs to list?
See, I'll tell you the story. We are like 142 years old, and we are probably the 10th largest or 9th largest.
You look good for your age.
Yeah, not me. We have the largest number of stocks listed in any exchange in the world, like more than 5,500. And so we have a long history, but there was a period, say in early 90s, a lot of small companies came to the markets, they raised funds, and then they happily vanished. And so we had a kind of a backlog of public memory that if you allow every Tom, Dick and Harry to come and raise funds and not comply, basically you create a lot of distrust in the market. So the exchanges which are now surviving too, BSE and NSE, both raise their minimum requirements for listing to reasonably high levels so that the small guys cannot come in. And in 2010, that is after almost 20 years, the government woke up and said that the small companies have a legitimate need to raise funds from the markets, and you are not allowing them. So you guys have to allow. And we said no, but then every time these companies raise funds, they run away. We get blamed, and we don't want to be blamed, so we don't want to do it. And so we had a kind of a lot of to and fro. And then we said these guys die faster than the large ones. So we need to ensure that the small guys don't come in, so that there is no protection required for small guys. And so we basically worked with them to come out with a number which is reasonable so that the sort of large guys can invest in. So in India, if you want to invest in a share, you can literally in a stock, you can put in 5 pence in US dollars and still buy a share. But in SME, which we basically said we'll have minimum $1,500 as the minimum lot size. And so we increase the lot size to manifold. In terms of sort of convincing the merchant bankers, that is investment bankers, because if you go to the large guys, their ticket size is such that whatever the company raises will actually be going to pay for the lawyers and the investment bankers. And so we had to create a new set of investment bankers who can work at a kind of a lower numbers. We had to also go out and explain to the companies, because most companies are very wary of coming out of the markets for a variety of reasons, but increase in compliances. But that is true with both exchanges. It's not only with us, but that you'll have to start disclosing many things, and also on periodic basis, which they are not used to. But they also have worries about losing control by the entrepreneurs and so on and so forth. So we had to actually do a lot of marketing, create role models, and at the end, basically, the NSE, which is National Stock Exchange, is a more into trading a lot. They have a lot of trading volumes. They are not interested in doing small little companies which don't trade at all, because today in SME, the minimum number of investors required is 50. And that means that it's very little trading. And so we had to do market maker programs. We had to convince market makers to do stuff. And so it took us some time, but in 2012, we launched it. And now we have done almost 179 companies. Each company raises average around 1.3 million US dollars. At the time of listing, it's the market cap of that company is close to $5 million. An average number of investors is kind of increasing from 50, 60 to now probably 500. There are kind of a good number of investors have developed who have got huge returns in this SME companies, because when they come to the market, they are very sort of not confident. So they raise the funds at very low cost, and then the prices go up, so everyone is happy. Yeah. And so the newer guys are actually benefiting from the older
from
issuers.
the reputational effect of the.
And so it's a very interesting framework. We have now 179 companies, and out of that, around 25 have gone to the main board. And so we ended up giving them a graduation platform that if you go beyond a particular size, we take you automatically into the main board, and you don't have to spend large sums to raise funds and stuff like that. So, but it's been kind of very happy stuff. Only thing is the other exchange didn't take it because it doesn't trade at all.
Okay.
You have to.
All right. Let me pursue though this question of, I've heard a couple of things now in this panel and in the roundtable that we did earlier. Sometimes these are family firms. They just don't want to give up control. They don't want to list. We're kind of shoving this down their throats. They're not interested. Second, though, they may be interested, but they're just not sure how. So there's this hand-holding requirement. Third, it may be that they even know how, they are interested, but they think this regulatory burden is just too onerous, right? And then at the same time, you want to make sure that the halo effect of the exchange is such that other companies want to invest, and then investors aren't getting burned. So let me just throw it out to anybody. How do you balance these competing kind of ideas, and how do you sort of chart a way forward for the right balance? And
can I jump in?
Yeah, absolutely.
So your comment about family businesses. So we looked, actually one of our dealers looked at the success of family-run businesses in our ecosystem. And what they found was, and I think the research is over 20 years, they found that family-run businesses on balance actually do better than non-family-run businesses. Now, the concern, as you rightly point out, if I'm a family-run business and it's been in my family for X number of generations, going public is a scary proposition. It is, but there are tools on most exchanges that allow you to affect that outcome and give you the protections that you think you need.
Okay, what are those tools?
Well, like preferred shares, there's different structures that allow you to get multiple voting shares that give you super majority voting, and it just, there's a litany of those tools that exist, and I think what is not well understood is how to leverage those tools. Okay, second thing is, you talked about the not knowing, actually no, let me go to the regulatory burden comment. Yeah. Too onerous. And for me, and what we see a lot in our marketplace, and for those of you who in the panel this morning, forgive me if I'm repetitive, but the challenge is in our market, you've got the conversation around public funds versus private funds, and in this instance, private funds, we're talking about venture capital. Okay, so as a venture capitalist, if I give you money, I have expectations. And the expectations are return expectations. And I also have transparency expectations, and I also have a litany of other expectations. Not the least of which is I'm going to write certain things in the agreement between us that give me certain advantages. Now, I'm not saying one is good, one is bad, but what I am saying is if I am an entrepreneur and I'm looking for capital, I should do my homework on understanding what the benefits of one platform are, private capital, versus public capital. Private capital, yes, it's out there, but to your point that you mentioned earlier, if you are a listed entity, raising further capital is quite easy, okay? One. Two, as someone who owns a business, and again, I'm just going to share a quick example. There was a company called TIO Networks on the west coast of Canada. The gentleman Hamed started up his company in 1999, if I remember correctly. He just sold it to PayPal for $310 million. 19 years. There's no way he would have existed had he gotten private capital. You know, it's a 7-year fund. Sorry, Hamed, you're out. Like, you will get recycled. The average CEO who gets private money in terms of VC, what I saw was 3 years. So Hamed never would have made it. And the shareholders in his business also would not have made it. My point there is there are vehicles and there are, the platform works for the right companies.
Yeah.
Staci, may I jump in?
Yeah, let me just, I think you make an interesting point though, which is that the rules of the game, they may be difficult, but they're clear and they're standardized and they're the same for everybody, unlike in the private market. So yeah, Anna, and then I think Siobhan, you're also looking to.
Well, I'm going to put my hat as a former regulator and try to answer your question regarding the regulatory burden.
Yep.
And I think Nick explained very well the pros and cons of different markets. And the reality is that in the public markets, there's an expectation of transparency. Sure. You don't have that arm's length relationship. So you need that transparency. You need that corporate governance. But I agree, there's important to have a system that is fit for purpose. SMEs are different in nature, and the regulatory framework needs to account for that differences. The challenges that we see in many emerging markets is that, yes, there's proportionate framework, but then where is the supervision and enforcement? And at the end of the day, a regulatory framework is as strong as the supervision and enforcement are. So in many of the countries that we work in, one of the main challenges is how to bring that. In some countries, it has to be through the exchanges and the monitoring of the exchanges. In others, it has to be by bringing more oversight from the public regulator. I like a comment that Nick made in our private roundtable, that he said that his exchange was like crowdfunding, but with adult supervision. That adult supervision is key for these markets to work well.
Yeah. Siobhan?
Yeah, so I just want to add in on the point about loss of control. I mean, we're all deeply concerned about that as a disincentive for people to list. But firstly, I mean, you give up a fair degree of control of the direction of your business, expected returns, et cetera, when you accept private money. I mean, I think people need to accept that. So the education component is very important. Secondly, once people have taken the decision, once they've taken the decision to access public markets, and remember, in many instances, these are people who need financing to do the things that they want to do. They've kind of accepted that part of what they're doing is giving up a degree of control over the company, not entire control, because in public markets, shareholders don't generally have the right to appoint the board of directors or set the direction of the company that you do when you're taking private money. But interestingly, in the research we did, one of the areas we asked listed companies about their expectations on a variety of factors pre-listing and post-listing. So was your experience better or worse than your expectations pre-listing? In almost every market we looked at, loss of control was better than expected. So in fact, the experience, people seem to be more concerned about this than the reality ends up being once they're in the public market space.
Yeah, I was just thinking about your comment on the family-run businesses. In our universe, if you take our top 60 companies, these are big businesses. I think it's 13 or 14% of them they're still family-run, and these are businesses that have been around for a long time. Some of them, I think one of them is upwards of 100 years. So it is possible to maintain that family control, if you will. And the other thing I want to come back to on the regulatory front, with no disrespect intended, but we can't protect every investor. When you're going to invest in a venture company or a small, medium-sized enterprise, guess what? They could fail. It could happen.
Big companies.
That's, there are other ones that have done the same in much larger market caps. So I think what we need to do is we need to accept the fact that this is about the velocity of money. This is about innovation, job growth, all that other good stuff. And yes, we hope people make money. Absolutely, that's certainly part of it. But again, it's about just kind of building up our individual businesses and economies. And I don't mean ours. I'm talking about the ecosystem. I just think that we get too hung up on the notion of capital formation versus investor protection. When the needle tilts too far towards investor protection, you get nothing done.
Yeah.
That's the best way to protect your investor.
Yeah.
Don't do anything. But you go the other way, and there's too much reckless behavior. So I think the needle needs to, you just need to be as transparent with the conversation, and again, no disrespect intended, but.
Yeah, okay. Well, I want to talk about some of that ecosystem, but let me first take your comment and say it in a kind of obnoxious way, and then get your reaction to that. Look, reductio ad absurdum. These are retail household investors. They are not sophisticated investors. In a lot of countries, they are not a sophisticated regulatory environment and enforcement. These are SMEs, these are venture companies, and so are you honestly suggesting that we are taking the least sophisticated investors and asking them to put their savings in the smallest companies that are most likely to go bust? And is that really the way forward for economic development and prosperity? What do you have to say for yourself, Ashish?
I mean, in some sense, that's why we didn't want small guys to come in, but the government wanted the small companies to come and raise funds, and we said we don't want them because that's precisely the problem. And then we negotiated and came out saying, in the large companies, you can invest even 5 cents or half a cent. In small companies, because they can die faster, we want larger guys to come in. And so $1,500. Now we are setting up a new market, which is actually the high-tech market, which is called BSE High-Tech. Not yet a single company has come and listed, but there they can die even faster because they burn a lot of money every day. And that's why we are putting basically $15,000 as a minimum lot size, so that we are trying to kind of differentiate that the smaller investors require larger protection, and the larger investors per lot require smaller protection because they can handle themselves, and of course the rewards on the other side can be. So we are trying to do what I call graded protection, if you may, and that's where probably the Indian system is coming to that. Everyone doesn't require all protection at the same time, and the large guys can handle smaller. So that's how we are trying to kind of cut the cake, but who knows,
No.
Can I jump on that one?
Yep.
So let's pretend you've got a business, okay? You got a great idea. And you've sold some of your friends on that idea, and they're like, you know what? You should try to raise money for that business. What he offers and what we offer is an ability to do that. Okay. Now, it gives you all the benefits of being public. You can get liquidity, all that kind of stuff. But the reality is, as a little business, you go out and you're selling your story. You're telling that story to your investors, and you're telling it to, and guess what? You get investors, they buy into your story, and off you go. And then all of a sudden you get a contract. And then you get to the next level. So the reality is, yes, it is venture capital, it is venture finance, but it's at least giving those investors, the entrepreneurs, access to another set of capital. In our marketplace, retail is very well, it's a well-established mechanism to raise money.
Okay, but you guys, you're big countries, and you've got big exchanges with a lot of listings because you're big countries. Anna and Siobhan, while I'm in this kind of big obnoxious mood, let me ask you this. Why is it that you're helping small countries and developing markets build their own domestic capital markets? Shouldn't they all list on AIM in London, or wouldn't it be better for investors, wouldn't it be better for the companies to just have a couple of global exchanges and not, isn't this just kind of flag planting in all of these countries, and is it kind of inefficient, and liquidity begets and needs liquidity, and maybe it's never going to be there? So is this the right kind of model for countries?
So let me start. I think a stock exchange is not just about the institution of the exchange, and it's in fact more appropriate to talk about capital markets more broadly. And the importance of domestic capital markets is that they assist in mobilizing domestic capital. So domestic capital markets don't in fact exist to attract international capital. International capital tends to be what happens once you've got a reasonably well-established domestic market. And domestic capital markets bring with them benefits that flow from having an appropriate legal and regulatory support structure, from having intermediaries, and all of those create virtuous spillover effects that contribute to the growth and development of the economy at large. So absolutely, if all you were solving for was companies raising finance, sure, then the largest companies may be able to raise capital in some of those other markets where they are aligned with, so if you're a mining company, absolutely, you can go list in Toronto and raise capital there. Why? You've got an investor base that understands global mining. You could probably do some stuff on AIM. But the reality is it's the domestic investor base that understands the domestic economy and can allocate funds appropriately. So is every market that we've looked at, I mean, our members tend to be the sort of more developing markets, but is every market creating a successful market? Not yet. But is it important to contribute to developing a domestic market? I think absolutely. I don't think global markets substitute for domestic markets in a meaningful way.
Staci, let me echo many of the comments that Siobhan made. Developing domestic capital markets serves several purposes. I'm going to focus on SMEs, since this is the forum that we are in. When you look across the world in who invests in SMEs, international investors do not invest in SMEs because they do not know these companies. First, there's a problem of research. First, there's a problem that they don't know them. They are not close enough. They are little. Why to know them? And second, in many countries, there's a problem of there's not even research out there. So securities intermediaries do not know either those companies. So the reality is that for SMEs, domestic capital market is what initially they can aspire for. And that's what is important. Now, one comment that I made earlier that I want to emphasize is that, however, in our view, we need to think more broadly of the role of capital markets, because for many of those SMEs, the public markets are not going to be the first avenue that is available to them. Rather, in many countries, it's going to be more about indirect ways in which capital markets can help financing those SMEs by leveraging banking funding, by leveraging trade financing.
Yeah. Okay.
So I think you mentioned AIM probably because of the past. For me, AIM is nobody. And second thing is
fighting words right there.
Right.
I'm with you.
And yeah,
I'm with you.
I mean, probably AIM is dying. Okay, but if any country wants to set up a market, and I can provide them infrastructure at pretty much zero cost. Okay, so they don't have to even have computers there in their country, and through the internet they can do whatever. So I just wanted to be aware that today it's easy to do the entire technology outsourcing. But as she said, you need to raise funds, because if it's a $1 million raised, how would outsiders even know the company and stuff like that? And so we work with many countries in our region to help them prepare for the SME markets and stuff. They come and sit at BSC figuring out what we do, and we go out there trying to figure out the regulation and stuff like that.
I'm just going to riff off what's been said. So in terms of, I actually think that there is, now maybe not so much in the SME space, but certainly capital will move to invest globally. Again, SMEs a little less or so, but it does happen. There is the awareness issue, and certainly there's not enough research out there. But in this day and age of information transfer, it's starting to become a little bit easier. And actually, we're working on an initiative to kind of do something on that vein. I can't talk about it now, but I will hopefully be able to talk about it next time. The other thing is, in terms of...
Come on.
I can't, I'm not allowed, sorry. No, I have to twist my arm. On the topic of adult supervision, which...
is it a new market, or what is it?
Come on!
He's a public listed company.
Yeah!
You started.
You're going to get me in trouble. So on the topic of sort of capital formation with adult supervision or crowdfunding.
Is it bigger than a bread box?
A little bit. The reality is, when you think about a lot of these small companies, the framework that you have of regulation is it's important. And I know you mentioned that earlier, Anna. And we did something with the Santiago Stock Exchange a few years ago where they basically outsourced a good segment of their venture market. So they have something called the Santiago Venture Market, which effectively is us behind, so we white labeled.
Yep.
But it's really our rule set
Yeah.
and our framework.
Yeah.
And we give them access to some technology. But I think it's really it's creating this ecosystem.
Yeah, and I want to pursue this idea of creating an ecosystem. And sometimes you need to add a little bit of juice to the carburetor to get that ecosystem going. And that can be in the form of better integration with the banking system. It can be in the form of exchanges doing a lot to kind of handhold companies through. The role of intermediaries can be very important. Early stage investors. I mean, I always think that if SMEs are too small and risky, maybe it's a vehicle of like a unit trust or a mutual fund or a VC fund of a number of SMEs that can in fact list. So can we just talk a little bit about some of your best ideas for getting this ecosystem going? And then I want to also leave some time for questions from the audience, questions and comments, because we've got some pretty serious people in the audience.
May I jump
Sure.
in?
Yes,
Join
please.
in.
Yeah,
Okay.
I mean, all ideas welcome.
Perfect. Let me give you two ideas. And again, it's in this space of how to leverage traditional funding sources like banking or trade finance to further leverage SME financing with capital markets instruments. First one, as you know, many institutional investors are not interested in SME issuances because each issuance by itself will not move the needle in terms of the profitability. And so what one needs is to bring all these issuances to a level that make them a sizable investment. So what we are seeing in many countries is the creation of SME debt funds, SME bond funds, for example, that then bring all these issuances together and make it much more attractive for institutional investors. And for example, in Peru, the IFC has been an anchor investor linking the SME debt market that they have created with institutional investors. Second example, as you know, it is customary that when SMEs sell their goods and services, they actually have to give credit to the companies that they provide their goods and services. And sometimes this credit is not 30 days, 60, 90 days, and they are in need.
Supply chain financing.
Yes, and they are in need of cash. And in many countries what you have is factoring, but this is the beauty of capital markets. What we are seeing, and a lot we're seeing in Pioneer in Latin America, is capital markets helping SMEs get that liquidity through two examples. In Chile, you were mentioning Chile, has the exchange has a platform for selling receivables. And in Peru and also in Chile, there are funds actually that buy those receivables under the basis of reverse factoring. And what is the beauty of it? That the credit risk that investors are getting is not SME credit risk, is the risk of the large companies in those countries for which already there's information available. So I think that those are the type of instruments that could deliver, that could yield a lot of impact in the short term while we develop the public equity markets.
And has it been difficult to get these off the ground? And what are some of the lessons that
Yes.
you've learned in trying to execute on some of these ideas?
Well, in some countries, there are certainly preconditions that need to be met. In many countries, factoring exists. So it's about reviewing, for example, whether a proper framework for the transfer of rights is in place. It's about these type of vehicles can be further leveraged if there are electronic receivables that make it much easier to transfer that. And that is one thing. And then obviously to have a proper framework for funds. That has been key.
Okay, that's fantastic. Nick, you
Just kind of playing off your comment about institutional investors or larger investors. If you want access or you want exposure to the SME market, the problem that you'll hear frequently is they're just not big enough. So, one of the things which you may or may not know is that the very, very first ETF on the planet was created where? This is in Toronto. Anyways, I'll leave it at that. But so what we're thinking is, how do we come up with a structured security or a basket security that takes into account a number of small SME businesses and puts them into a basket? We haven't done it yet, but it's a little bit harder than we had imagined.
Why? Why is it harder?
Well, first of all, the mechanism that the construction of the ETF mechanism doesn't actually port that easily to the example in the basket of small cap. Liquidity is an issue. So what you're going to have to do is you have to substitute your risk. So there's a number of things beyond that I actually can't recall because I'm not actually on that project, but I'm not one of the folks on the team is. So it is one of the things that we'd like to try and solve. We think that there's an opportunity there.
What other things have you done to kind of get that ecosystem jump started?
So the best part of the ecosystem, to be at least in our estimation, are the small dealers. The smaller investment dealers, intermediaries, they are the ones that make a lot of the magic happen. Because what they do is they sit with the companies, they identify the opportunity, they sell them, they roadshow, they do research, they do all the things that you would expect is being done for large companies at a smaller scale. So our concern right now is with the way things have been evolving in markets, more regulation, higher cost, those smaller deals have been squeezed. So we've seen a big degradation in that community. So that's something that we're quite concerned about.
And Ashish, you've also focused very much on intermediaries, among other things. So what are some of the positive mechanisms you've taken to get this ecosystem up and running?
See, the way we are looking at this today, there is huge amount of funds invested into sort of venture capital backed companies which are not actually having exits. So probably $100 billion plus is stuck in India, where the venture capital has invested huge, basically with a valuation in mind which is not coming. We are telling them that list on the SME platform, and so and each time now you invest, you actually list the company there and then, so there is no worry about the exit, and you get kind of straight away an exit. So that is kind of getting some interesting traction, and that's why we have created the high tech market also.
Say a bit more about that.
Basically, what one way to do is to tell the company and the entrepreneur saying you come and list. Other is to now go and hit the venture capitalist saying you have a large portfolio. Why don't you list your companies, because you are not getting exit anyway. So you come and exit onto us, and that way basically these companies become sort of public in many ways. The second thing is we are trying to project this as because the way we look at it is in future, going forward, the raising of funds is going to be less of a problem because the newer businesses are less capital intensive, but they create huge wealth if they can actually list at a very early stage. So we are also kind of marketing this as a wealth creation platform more than only raising funds for your day-to-day business. So it's like giving them a vision that you can be a Mark Zuckerberg if you list now. So what we tell is we have three legendary sort of billionaires in India. There's a guy called Dhirubhai Ambani who kind of came out of nowhere and created a $50 to $100 billion sort of stuff. Similarly, Tatas, which are $100 billion. And so we tell all our entrepreneurs when we do this sessions, like we have done 500 till now, saying these three guys, what is common amongst them is that they listed on BSE. So if you list on BSE, then you can become like that. If you don't, you can never reach there, right? So, and that kind of gets those guys going, saying, okay, if I want to grow and become large, you need to do this. And third thing, which we are just now trying to market to basically the governments. We have 30 states in India, 29 and a few others. So what we tell them is, you are giving a lot of subsidies to the small companies for machinery and so on and so forth, but that subsidy goes away, it basically doesn't come back. Instead, if a company is listing on BSE, BSE's SME, that time you put in around $100,000 each and as an equity. And so if you have, like as a state government, if you have a fund of $5 million, which is easy to do, you can invest in practically 100 such companies. And that money, after 2 years or 3 years, you can actually sell out and use again. So it's kind of a recirculation of that money keeps on coming, instead of putting money in subsidies, which are very large and nobody knows where it goes. So we are kind of coming out with newer proposals to different types of people and hoping something sticks.
Siobhan, have you seen any other ideas from your members?
Yeah, so I mean, what we're seeing, and I'm sure both Ashish and Nick will have examples of this in their own markets, but some of the other members we've seen are essentially having to move into different parts of the value chain and come up with more innovative ways of collaborating with other parts of the ecosystem. So Deutsche Börse, the German exchange, actually before relaunching their SME platform, launched a venture market, which is essentially facilitates private investment in companies, recognizing that one of the gaps in Germany, in fact, was the availability of sort of venture capital PE investment. So what this facilitates is global venture capital private equity investment into German companies. The exchange then works with those companies as part of that process to then start to bring them to market later stage. It's only been running for, if 2 years, that's a lot, and they've already had at least one, if not more, companies coming out of that process listing on the exchange. So that's the one thing, recognizing where there's an ecosystem gap and seeing how the exchange can help to plug that. But just to pick up on a point that Nick made, I mean, I think one of the challenges, and it's particularly the case in emerging markets, but even in developed markets, one of the challenges that we have is that the economics of public markets are being squeezed, right? So more and more, the reality is servicing anything, whether it's the exchange, the intermediaries, servicing anything other than the largest companies is becoming uneconomical for a lot of intermediaries. And so we have to find ways, we collectively have to find ways, because I think public markets and listed public companies are very important public good, to find ways to address the economics, to make it more viable for that servicing of other sectors to happen, the smaller companies to happen. There are opportunities, we were speaking to someone this morning, potentially around using technology to streamline the process of filing regulatory documents, so it's not as manual and labor intensive, and you don't spend as much time as regulators double checking the accuracy of documents and having to follow up and all the rest of it. Research coverage. There are now companies that use algorithmic techniques to automatically generate basic research coverage of the kind of stuff many exchanges now pay research houses to produce for the smaller cap companies. So I think there are opportunities there, and we're starting to see some of that stuff coming out, but we need to focus more attention on that side of things.
What about some of the more sort of heavy-handed mechanisms, requiring pension funds invest a certain percentage of assets in local markets, privatization that sort of requires listing on public? Are these misguided, or are these important ways to kind of get markets going, in your views?
I used to run a broker-dealer, Canadian business, the Canadian business of ITG, and I would have answered that question with a swift absolutely not before I was there. Before I came to the exchange. Sitting at the exchange, and it's not just changing your jersey or your T-shirt, but you have a different insight, you have a different perspective now. And I would say that, and you started to hint at this in one of your earlier questions in terms of, why don't we just have one global exchange? Well, because global exchange mergers haven't really worked yet, right? Like, they've tried in a number of instances, but they haven't really, and part of it is because the formation of capital in a domestic economy is exactly that, formation of capital in a domestic economy. Now, there's international capital that comes in, but the local company that started off on your corner is going to be best known by the folks in that community. So when you think about the importance of, I forgot where we're going with this.
More heavy-handed.
Oh, yes. Sorry. Getting old. I kind of feel like you just need more involvement, frankly.
Staci,
Yeah.
may I jump in? We have seen many experiences of privatization being used as a catalytic for market development, and unfortunately, the market didn't follow. And when authorities, and very recently, I cannot say the country, but when authorities ask us,
the secret on this panel?
When authorities ask us about that, what we say is they might be catalytic, but you need to make sure that the pipeline of private companies is following. You cannot base the development of your market just on thinking that I'm going to privatize 3 SOEs and then the others would come. You will have to have started already with the development of your pipeline. And on the issue of forcing institutional investors to invest in SMEs, I come from an emerging market, and in my country there are that type of policies, and what we have seen is that they could have very a distortionate effect, because while they are not other securities, you're forcing these institutional investors to sometimes hold securities at prices that are really below market. And so they could have a distorted effect, and we are very careful in the way we recommend this because of that. I think that in the end it's about what we have tried to spoke all along, which is you need to build the whole ecosystem. It cannot be just through forced policies. The other elements need to make sense, and as Siobhan was saying, the economics need to make sense.
Do you have something you want to add to that, Siobhan, or are you?
I just wanted to say, I mean, to that point, I mean, potentially on the privatization, forced investment, etc., but only if you in fact have the correct regulatory framework, transparency and corporate governance.
Yeah.
Otherwise, I mean, you're engaging in theft from pensioners, I would argue.
Yeah. Okay, let me stop here and open it up to the audience for any questions and comments. We have a mic coming around, but let me just see on a show of hands. Did you want to? I would like to start, if I could, with the former regulator of the Nigerian Securities and Exchange Commission, now the treasurer of the World Bank. Rumna, if you want to maybe make the first comment, and then just kind of keep your hands up, and we'll call on you.
Thank you, Staci, and all the panelists for what I consider is an absolutely outstanding conversation that you've had. I was not hoping to be to have to be cold called and speak, but I do want to say something, which is which Scott will probably like. I think once a regulator, always a regulator.
Yeah.
So as I was listening to the conversation about SMEs, I kept saying to myself, I do want us to think about SMEs coming into the regulatory umbrella, because I think it's good for the country. It's good that when businesses start, that early in the businesses, when they start, that they start to understand what it means to be a good company. And so I was very pleased with what my colleague Anna was saying about some of the new initiatives to try and make sure that we're doing more to get SMEs on board. Because the ecosystem that the financial services sector creates or encourages is extremely important to the well-being of a country. And SMEs, they're the ones who create the jobs. They're the ones who make the difference. They're the supply chain for large companies. So they need to come into the oversight of quasi-regulators like stock exchanges and regulators like SECs. Thank you.
Okay, thanks. Okay, in the back, in the back, and then here. We'll collect all three together, and then we'll turn it to the audience.
Hi. It seems to me if you reframe the question as how to increase access to capital to SMEs and provide a broader set of investors beyond the largest institutions access to the premium returns of SMEs, then the most logical and easy way to do that is to allow better access to the professional managers who already manage these pools of capital, the venture funds and private equity funds. That experiment's been going on in Europe for 30 years, the listed private equity market, the best known firm being 3i. Almost all the rest of the firms have traded at discounts to net asset value and struggled, particularly since the financial crisis. And it's gone on in the US through the business development company phenomenon, which remains poorly understood and poorly regulated, in my view, and an opportunity for more, simplicity. So if that's the question you're trying to ask, the obvious place to start is with the reform of the 40 Act in the United States, which drove firms like KKR, Apollo, Riverstone to list their vehicles in Europe. And I'll stop there.
Okay, all right, thanks. Let me just collect them all, and then then we'll go down the line. You can respond. Please introduce yourself.
Okay, thank you. My name is Daniel from the Capital Markets Authority of Kenya, and thank you. It has been a very good conversation. Probably what I would what I would like to hear more about is the issue of cost. I don't know whether it's perception or it's real, but I think evidence suggests that cost is not as high, that is cost of listing, compared to bank finance and other sources, when you're talking about the VCs and Ps. Here, when you're looking at cost, the legal costs, compliance, audit, and all that. So what should regulators and exchanges do to navigate this issue and kill the perception that cost is significantly higher compared to the other sources of finance?
Okay, terrific. And then one quick question up front, and then we need to get back to the panel for answers. Yep. Yeah.
Maybe more of an observation. Well, two. One, great panel. And number two, just on the topic of adult supervision and investor protection. I think we need to make a distinction between companies that fail because they are not good companies and they're not, they don't, their business model is an issue, versus the need for investor protection from fraud. Because as we have seen, and I'm sorry, Scott Birdwell from the SEC, these SME companies are just ripe environment for all sorts of fraud and abuse. And when you get that mixed in with that ecosystem, that scares people away in a hurry. And so that's, investors don't mind, or at least they know that they're investing in the risk of the venture, but they don't want to invest in the risk of fraud. And so that, I think, is an important distinction.
That's a very important distinction. I'm glad you made that. Okay, so I've collected all of these questions and comments, and I'll go down the row and allow you, in the 5 minutes that we have left, have you address, to the extent that you want, each one of these. And then I'll ask you, as you end your comments, the theme for this conference is leading a meaningful life. So I will also ask you as your final observation, please, what in your view does it take to lead a meaningful life?
Who wants to start?
Well, no, can we start that end?
Okay.
It's too hard.
Okay, Anna, respond to the questions and then the meaningful life, please.
Okay, well, it's a tall order. Okay, I just want to emphasize that point that I made at the very beginning of thinking holistically about access to finance. It's not about equity financing, it's about how to improve financing for SMEs. And there are many other alternatives that in some of the emerging markets might deliver more bang for the buck. As to what it is to live a meaningful life, let me put that in the context of this panel and actually the mandate of the World Bank Group. Capital markets are not an end in itself, are a means to an end, are a mechanism to allow companies to grow, and by growing to expand, to have economic growth, to reduce poverty, and have shared prosperity. And that should be a meaningful life.
Fantastic.
Yeah, for me, basically, I think we didn't touch upon one subject, is that BSE also runs an incubator with Canadian University within the BSE premises. And we fund very small businesses in high tech. And over the last 3 years, we have funded 108 companies. Some of them have gone to become, at least in money size, they've gone on to become even $150 million of raise and so on and so forth. So it's kind of coming out to be very, very interesting framework. So we want to be in all stages of raising funds, from crowdfunding to the incubators to venture capitals to private equity to SMEs and so on and so forth, and the main board, of course. And so we want to be there everywhere in equities, debt, derivatives, and so on and so forth. And basically, in terms of the meaningful life for an exchange, basically over the last 20 years, all exchanges, especially in developed markets, have gone on to what I call becoming profit-oriented, profit-motivated, and largely, because of that, they've gone into derivatives. Very little fundraising happens, very little relevance to the society has actually remained. They have become basically what I call glorified casinos. And many countries, there are no casinos, so you end up trading here. But effectively, if the exchanges don't remain relevant to the society they are in, that is creation of jobs, raising capital, raising wealth, and so on and so forth, they are nobody. So for me, the meaningful life for an exchange is to try, I mean, of course, you need to make money. I mean, I am a listed company, so I have responsibility to my shareholders, but I also need to create something which is basically helping the society so that I remain relevant for next 140 years in addition to my past 140 years.
You know, I've been in this incubator, and it looks just like a Silicon Valley incubator. I mean, there's beanbag chairs everywhere and all of this. Okay.
Okay, one thing, just picking up on some of the comments earlier about the one thing I cannot stand is this whole notion of that companies are too small to be public. And I actually don't buy that argument, but, and then in terms of relating that to today's world, you know, all of us in this room, or many of us in this room, would have had an opportunity to invest in Apple, in Microsoft, in Intel. Well, but hang on. Facebook, your first crack was when it was a $9 billion company. But all those other companies, they're much, much smaller, you know.
SME in a dorm room.
Right, so, but I guess my point is, you now have this two-tiered system of those that can invest in certain companies and those that cannot. And right now, we're mostly in the group that cannot. So that's one thing. Second thing is in terms of meaningful life. I guess when I think about the comment more broadly, it's about trying to give people an opportunity for success, a platform to be successful. And then how I relate that to our business, we're all about, to Ashish's comment, we're all about trying to accelerate these businesses and trying to help them grow. They're not all going to make it, but our obligation is to try to make that happen.
Yeah. Okay, Siobhan.
So just picking up on the alternative vehicles and alternative listed vehicles, I think all of those, I mean, we should be throwing everything we can at fixing this problem. But I do think we should be very careful of suggesting that that means we can just move away from public listed companies entirely, because it's not just about finance. We should all be very concerned about the decline we are seeing, particularly in developed markets, of the stage at which companies are coming to market and the decline in the number of public listed companies overall. Because one, I think it's reflective of other things that are going on in the economy, but also because listed companies bring with them opportunities for diversification, transparency, governance, all the good stuff that happens in regulated markets, and simply substituting that with conglomerate vehicles is not, I think, a good thing overall. On the Nick and I obviously collaborated on our ways to live meaningful lives, but I would suggest just generally finding ways to promote access to opportunity and inclusion would be good.
Yeah, okay. Giving people access to the capital that they need to do what it is that they do best and put it to the most productive uses. That's the point, right? So thank you very much to my panelists, and warm applause.
Thank you, Staci.